Market Watch. Here we are. I'm recording this on the 9th of July and we're at 5.25% still. We've been there for such a long time. Now, of course, in my last month's update, I said, particularly with the election coming, even if all the ducks were lined up for a rate reduction, I didn't see the Bank of England pressing the button. They didn't. And so now we got to wait for the next meeting. So the question, of course, on everybody's lips, particularly with inflation now being at 2%, which is the Bank of England's target. And in simple terms, they said when we're hitting those targets, we should be looking to reduce rates. So, of course, we were expecting the Bank of England to do so. But do you know what? I'm not 100% sure. We've got the next Bank of England meeting on the 1st of September. So, yes, the headline inflation is at 2%. But, of course, it's more complex than that. It's more... The Bank of England are going to get under the surface of inflation and look at all the component parts. And I'm not sure just yet that all those individual elements of inflation, in particular wages inflation, are going in the right direction. So there's some more data, more reports coming out in about the next 10 days that I think are pivotal to the Bank of England's decision on the 1st of September. So do not be surprised if they don't press the button at the next meeting. Hopefully, if not for September, it will be in October. Look, I'm really hopeful. I think it's still likely that there's going to be a drop, but I wouldn't be surprised if the Bank of England pause it for another month. And here's why. The last thing the Bank of England want to do is to jump just that little bit too early, drop rates in on the 1st of September, and then find they've got to reverse that because some of the little worrying niggly parts of inflation are actually starting to go in the wrong direction. And then they've got to all of a sudden reverse that. That will send absolute chaos across the financial markets with this flip-flop approach from the Bank of England. So the one thing we should be reassured of is once the Bank of England do press the button, because of their prudent nature, I think then we will be on that trajectory of further rate cuts towards the end of this year and into 2025. So what's been the impacts with the election? Well, certainly, I think some really great news. You may have seen it already, but we've got high street banks now really jockeying for position. They've got more certainty. They know the government that's in town, even though the Bank of England rate hasn't dropped. They're actually cutting their margins again, and it's getting more competitive. So that's great news. If as a landlord, you're still able to get your buy-to-let mortgages from the high street. And that, in essence, usually means that your portfolio is 10 properties or less. If you're now about to hit that 10 or you're above it, you'll already know you're not going to the high street lenders. You're now with the secondary market. The sort of rate cuts I'm seeing about 0.2, 0.3% generally speaking. But Barclays, wow, what are Barclays doing? They're having a fire sale. 0.7% reduction on their rates. Amazing. So might you qualify for Barclays? Again, I looked at their policy before I came on air today. They'll allow portfolio landlords with up to 10 properties, which is about as good as it gets for high street banks. So you might still be eligible to get some Barclays buy-to-lets there with some great savings. Now, what's the impact on mortgages in the wider field looking forward? Well, as I said, we've already got the high streets starting to cut rates, and I think they'll cut them even further once the Bank of England presses the button and drops the Bank of England rate, which will be 0.25% when they first start to drop rates. The secondary market, so these lenders that are not banks, not building societies, then these guys are not yet moving. They will need to wait until there's actually some rate cuts and the wholesale market's starting to drop their rates, and then they can pass that on to you. So we've definitely got these two camps, two categories. The high street lenders already starting to move and drop rates down, which is great news. But sadly, if you're a larger portfolio landlord, i.e. above 10 properties, then we're not seeing really any significant changes in rates. But I do expect that as we get into autumn. Takeaway message. Well, really, I'm thinking of you guys who are you've got a fixed deal. It's come to the end in the next few months, and it's whether you hold tight or you start to get the research done and get applications in. For me, I don't see a downside at all in getting your application in right now. Even if rates are going to drop in the next month or two, you can always secure the rate today because, look, if we've learned anything with Liz Truss and other things coming in left field to really turn the market on its head, then if we've got those rates locked in now, and for some reason rates start to go back up, not that we're expecting it, but we've already locked in the best rates we could have got. But if rates continue then to drop further between now and when your deal ends, as a broker, we can then get those even better rates. Even though we've locked in the rate today, if rates drop, we can go back to the lender and ask for that improved rate. So it's a win-win. So therefore, if with my landlord hat on, I will be putting your application in right now. And if you want to talk about your circumstances a little bit more, then there'll be a link under this piece. Just click on that, book some time in with the team, and let's see what rates are out there that are applicable to you.